All right, good afternoon. Today is Monday, the 25th of April, and the general theme here, I think, for tonight's video is going to be caution, more so than trying to, pick a big direction for a big move or something, more caution. I'll start by saying this, though, and I'll try to explain also, but all roads lead to 43.35 until they don't. All right, and I'll try to explain because I know that could be a little confusing just to begin with. But here's the deal. Caution. Why? We heard from the Fed Chair Powell last week, also ECB's President Lagarde. They're both hawkish. And their focus is inflation and the economy. And if you think back to like '08 and the financial crisis, every time since then the market would even threaten to sneeze, the Fed would come running, with some QE, and it's been that way for a long time. But they've made pretty clear since the turn of the year that it's no longer the case. They're talking tightening, and the focus now seems to be inflation and the economy, where the market gets to finally, for the first time, take a second chair or back seat, really. And Europe's the same. And so there's that. We're looking at, in the May meet, the Fed meet on May 4, we're looking at a likely 75 basis point. You can go to the CME website and look at the Fed funds tracking tool, the Fed Watch, they call it, on the CME website, and see what the market's pricing in. But right now they're pricing about 97% for 75 bips on the May meet. Likely 75 in June and then 50 in July. So that's kind of what we're looking at for a while. There's another thing that's on my mind right now too, and that's China. And the reason for that is you gotta remain focused on this China lockdown and what it means for the supply chain. Let me give you a little picture of kind of what I'm talking about here. This is satellite imagery of this is just satellite, right? So all these are just ships that are just staged, waiting to make their way into port. And that's a lot of traffic. You can get another kind of a look at that from marinetraffic.com, and you can see this is just tremendous, actually. This is all the green are cargo ships, and the red are going to be tankers, but the green, look at this amount of traffic that's just staged out here trying to wait their turn to get into port. Concern there is that as long as they remain in, lockdown, or to large degree lockdown, that's going to cause further congestion in that port, which is going to further exacerbate this supply chain issue. So there's that. And if that were not enough, this week we have major earnings, 600 plus to report this week. About a third of the S&P 500, and to start tomorrow with some major large cap names. We've got UPS, Microsoft, and Google tomorrow, then Facebook Wednesday, Apple, and Amazon Thursday. That is big. Now, in addition to that, this break, and the S&P is on the right chart over here, is a daily, on the left is a weekly. On the right, daily. This break from that 4,500 Thursday and Friday was about a 250 point range. Now, average weekly range leading into this for years now, average has been about 70-ish points, 70, 75 points. 250 is threefold, reaching into like a third standard deviation, which is really enough to catch a lot of people off guard in a big way. So I started by saying something. I said all roads lead to 43.35 until they don't. Here's what I mean by that. You see this trade, the way it went off up here at this upper balance, which we know was about 44, not 43, but 44, 63 or 4. And we talked about that last week and why it's quarterly settlement print. That's a big one. And then it's point of control for all of this trade, about a month worth of trade up there, right? So the way it goes into that level, it trades up into it, then it breaks below, then it goes back to it, traded above, back to it, trades below, back to it, then trades above, then back to it, and finally broke. And it broke, in a meaningful way. But where did it break to? But down, and surprisingly, to be honest with you, but did through the 43.35. So this 43.35 is bigger in order of like hierarchy or magnitude. This is a multi-year point of control down here. So this one surpasses or outweighs in importance the 44.60s up there. This 43.35 is just bigger because it's on a higher time frame. But the same kind of thing, right? We trade down to it, we broke below it. We'll come back to it, trade a little above it, come back to it, trade below it, until, the market gets meaningful information enough to reprice and kind of move decisively away from that price. So that in and of itself is not really that helpful in terms of, a trade and how you're going to trade that. I would say that I don't know that we've seen the low for the week. I can tell you two levels that you'll want to mark down here that have my attention below what happened today. Those are 41.87 and 41.63. The 41.87 is very much the same as the 44.60s up there. It's an old quarterly settlement print as well at 41.87. And then at 41.63, this was the weekly point of control down here on this week that just left out of this range in a hurry. That was the point of control that's naked still at this point because it's not been tested since it was produced. So there's a virgin or naked point of control down there on a weekly basis that traded, away in a hurry enough that it's not had a chance to come back and readdress that price. So this one's tough. I mean, this is going to be a tough one, right? We can break a little bit more and trade into, if you want to split the difference, I guess, the quant L1 quant print for this week, if you're familiar with that simpler indicator, is 41.70, which really pretty well splits the difference between the 87s and the 63s. In my opinion, it's probably 63, but I don't know that. And certainly with enough volatility on deck this week to produce some really wide-ranging rotational print, largely I would imagine around this 43.35. So like I said, all roads lead to that until they don't, which means that we traded below it, we trade back to it, trade back above it. Above it is probably something like 43.70 or 72 or something like that, and then back down to it, and then below it, and then back to it. That kind of just rotational around that. So there's a lot to say here, but the big overwhelming kind of theme here this week is more than anything. It's not like, okay, we get a breach of today's high, tomorrow we trade and target 43.70s and then fade back to 30 and then see about the earnings. Typically on a day leading into big tech names like Microsoft and Google tomorrow, market has a hard time historically in really staying down. I mean, it kind of tends to hold firm into names like that. The same with Facebook, Amazon, and Apple, and Google, and all those names. But I don't even know that I really want to get into breach today's high, trigger up to 43.70, fade that back to 35, and then see if later in the week it wants to trade down into those, 41. Honestly, if it does, it's going to be 63, but somewhere right in there, and then catch bid back into 43.35 until we get something, that it would be further out, I think, in time, but something closer to like the May meet, the Fed meet, that that's new information to really cause this to reprice. When that is the case, I would go to this weekly chart and start preparing for some ideas here later in the year. We got plenty of time for this, okay? But just imagine this, later in the year. Look, this S&P was 3,400 trade prior to the COVID news that broke to like 2,200 and then went wildly bid. This is insane price action from year 20 mid-year 20, a 2,000 trade in the S&Ps that trades all the way to 4,800. I mean, that there's there's some reconciling here to come, and when it starts to settle down, what I've drawn is a fib from this COVID low to the all-time high. We're resting on a 236 retrace. The next one down, the 386, is at 3,800, and then the half back aligns with the weekly 200 period moving average, which essentially aligns with the price where the S&P was prior to that COVID break, and then the rally. So there's a good bit of distance later in the year, but later, for this thing to to really come in. You can there. Let me show you something. See if this is maybe of interest. I may be getting a little ahead of my skis here, but I'll just show you. On the SPX, I like to do this on a quarterly basis. After the end of the March quarter, I go out to the next quarterly contract out here, and we'll go to, need the computer to catch up. All right, here we go. It caught up. Took a minute. And you go to every quarter. You go to the new quarterly front contract and go look for this trade. It's the JP Morgan's equity hedge desk trade, and it's always the same. You can find it. Just scroll all the way through here and you'll find it's 43,000 times. All right, so let's see. There it is. That's the bottom of the put spread, right, at 36.20. Up to, we're looking for 43,000. There it is. The top of the put spread, this is a put debit, is at 42.85. So they've got equity hedge desk, JPM's equity hedge desk trade has had protection from 42.85 down to that 36 number that we found. And that's financed with a call, a short call, and there it is. And so in this case, they're saying, okay, we're protected. Our equity book is good up to essentially the year open up at 4,700, and we're financing that protection down below 43 all the way into 3,600. You can do that every quarter, and it's really pretty remarkable to watch those strikes and how well they do help and play out. But another thing too is, don't lose sight of this. This is another one that's pretty interesting, is to look out on the June VIX and look at this. Look at the VIX is 26.7 today. Of course, that was, recently as like 20s. But look at the volume and open interest out here. Look at this open interest out here. 35, 100,000 times into, wow, look at this. 70, another 100,000. I mean, these are big numbers at much higher strikes in the VIX out in the June, where it looks like we were just past that Fed, May Fed, and they're looking at, like fireworks to come, right? Now, the next, and another thing, we're in an April by May expiration series that has a 5, not 4 typically, but 5 week span between the April and May expirations. So there is much more time in this case for inventory to be, kind of built up and hedged, but it's hedged, but built, by the dealers. And that rolls off largely right here in front of this May expiration, but it goes right in here. Look, the VIX expiration in this case is May 18. That's going to be a fireworks day, with 5 weeks between that April and May expiration and that VIX expiration right there on the 18th, leading into, typical monthly May expirations in this. In this case, it'd be the 20th, right? And that VIX expiration a couple days before, right there. That's a day for fireworks as well. So there's a lot of caution. There's a lot of caution in here. What we learned last week, a couple of things about, the midweek shuffle Wednesday and the don't try to be a hero and fade the Friday. The Friday move was quite the substantial break. I just discussed that with the magnitude of that move was threefold in the average week, and it occurred in 2 days. We got continuation ending on the lows on Friday. We got continuation all the way down into, and right about just past, it's usually 20-30 minutes past the European close, and you get right into this 11 o'clock timestamp, and boom, and we got the bid. And that was nice. We discussed that in the trade room. We got quite the bid, 4,200 trades all the way up into the 90s today. Like I said, all roads lead to 43.35 until they don't. I got it centered basically largely around the 43.35, but it can trade up into 75 and fail back down to 35. That trades it's really rotational, likely in my opinion around 35, but we've got weekly pivot right there as well. You can see this break, support, and then flush right about the 75s that we're talking about. So it goes into 35, trades above, fails back into 35, trades back down, finds whatever low it's going to be back up into. It's going to be a wild week. The theme this week is not a big trade with here's the target or something. The idea this week is to try to, as much as last week was put on a target, this one is to protect you from what can easily be a real headache. I mean, for a real loss potential with the volatility that I can anticipate, given all of these things that I'm laying out for you, and those are the inflation, the Fed, the ECB, this China lockdown, the huge earnings this week coming off of wild range last week, the 5-week span between the April and May expirations, the VIX expiration on the 18th in front of the May expiration, with the tremendous volatility or volume and open interest that I'm seeing stacked on that June VIX options chain that is telling. And in this case, we've also got that ID'd that JP Morgan's equity hedge test trade that's got, like I said, we're well into the put side of their protection at about 43 down into 36, and they're willing to write the 47s to pay for this protection, and it looks like it's not a bad call on their part at all. Listen, I hope this helps. We'll catch up again midweek, see where we're at, see if we can make a plan from there into the end of the week when we get some of this earnings behind us. But earningswhisper.com, you can see the schedule. It's a tremendous amount reporting this week. I think about a third of the S&P 500 and big large cap tech names all starting tomorrow, Wednesday, and Thursday. So notice caution, and hope this helps. Anyway, have a good trade this week. I'll see you again on Wednesday. Take care.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me